Welcome to Talk Tickers, your essential summary of the latest earnings calls. Today we're diving into Smith Wesson Brands, Inc.'s Q1 FY26 financial results. We'll unpack the numbers, explore what management had to say about their strategy, and connect it all to the broader market picture so you can walk away well-informed. Let's get right to the headline figures from Smith & Wesson's first fiscal quarter, which ended July 31st, 2025.
Okay, so on a GAAP basis, the standard accounting method, the company reported an EPS of negative $0.08, which interestingly actually beat the consensus estimate. That was negative $0.08.
Oh, okay. So a beat even though it's negative.
Exactly. And the non-GAAP EPS also came in at negative $0.08. So consistent there.
Right. And revenue hit $85.1 million. That's also a solid beat against the $79.1 million consensus estimate. But, and this is important, it represents a 3.7% decrease year over year.
Yeah, down year over year despite the beat. Gross margin stood at 25.9%. Adjusted EBITDA came in at $8.0 million, which translates to about a 9.5% margin. Free cash flow was negative $12.4 million. Now, that number reflects typical seasonal inventory build, so not entirely unexpected.
Right, prepping for later in the year.
Exactly. And they reported $21 million in cash and investments, with $95 million drawn on their revolving credit facility. And they declared their regular 13-cent quarterly dividend.
Okay. So on paper, some decent beats against expectations, beat on EPS, beat on revenue. But, the market's initial reaction was, well, quite muted, suggesting investors are digging a bit deeper than just those surface numbers.
Yeah, definitely muted. We saw just a modest uptick in shares immediately after the call, settling to maybe a 0.5% gain after hours, which is far, far less than what the options market had implied. That suggests, cautiously constructive sentiment, but not overly enthusiastic.
Okay, let's unpack this further then. What were the key drivers and sort of the underlying currents for Smith & Wesson this quarter?
Well, what's really fascinating here is the company's innovation strategy seems to be working. New products were a huge factor, actually accounting for 37.3% of total sales this quarter.
Wow, over a third.
Yeah, it's significant. The CEO specifically highlighted the robust demand for new products and the strength of our innovation strategy. They even saw a very positive initial reception to their new Shield X, which they introduced just in late July.
And here's where it gets really interesting on the product front, I think. Handgun shipments into the sporting goods channel increased just over 35% year over year.
35%. That's huge.
Especially when you compare it against NICS data for handguns, which was actually down 2.4% in the same period.
Right. So they're significantly outperforming the market there.
Exactly. And this strong performance was across key lines like Bodyguard, Shield, and M&P.
However, if we connect this to the bigger picture, long gun shipments told a bit of a different story. They declined 28.1% year over year. Yeah, while NICS for long guns overall was down about 7.8%. So a steeper decline for Smith & Wesson there. Management attributed this divergence to segments where they don't really play meaningfully, like shotguns and bolt-action rifles.
Okay, so it's not necessarily their core areas declining quite that much.
That's their explanation. They say they're maintaining strong positions in MSRs and, interestingly, the lever-action market. They're also continuing to expand their 1854 lever-action platform. 2 more calibers are apparently coming soon.
All right, let's shift to pricing. We saw average selling prices, or ASTs, decline 6.1% sequentially, so quarter over quarter.
Right. And breaking that down, handgun ASPs were down about 4%, but long guns fell a sharper 13%, which they said was due to mix.
Okay, so that raises an important question about navigating what management called a highly promotional market environment. How are they handling that?
Yeah, good question. They stated their focus on those new products and strong marketing allowed them to participate in promotions more selectively. Essentially, they tried not to just slash prices everywhere. They aimed to maintain relatively healthy ASPs throughout the summer.
And did they give any outlook on ASPs?
They actually did. They expect to maintain strong ASPs throughout the whole of fiscal 2026. That's quite a statement. We'll see if they can deliver.
Inventory management seems to be a focus, too. Distributor inventory sounds like it's in good shape.
Yeah, described as very healthy. It was down over 10% quarter over quarter and more than 13% year over year in terms of units. That suggests pretty good sell-through at the retail level.
Which is positive, right? Less channel stuffing.
Definitely. Now, on their internal inventory, they did acknowledge ending the last fiscal year with maybe a bit more than desired. But as they pointed out, firearms don't exactly have an expiration date,
Good point. No best buy date.
Right. So it gives them flexibility to adjust production rates rather than having to do fire sales. Seems like a disciplined approach to capital.
And speaking of strategic moves and capital, a truly big announcement was the relaunch of the Smith Wesson Academy. Tell us about that.
Oh, yeah, this is a big one. The Academy's grand opening is scheduled for September 12th. It's described as this state-of-the-art facility, nearly 30 acres, purpose-built ranges, training areas, classrooms, the works.
Wow.
And it's going to be led by Mark Cuiolo, a retired U.S. Navy SEAL veteran, firearms training expert, apparently served with SEAL Team 6, revamped training at BUDS. So, serious credentials.
That's incredible. What's the sort of the strategic purpose behind this major initiative? Is it just marketing?
Well, it's partly marketing, sure, but it seems deeper than that. The goal is to provide training free of charge for law enforcement, federal agencies, and military customers. That builds relationships, obviously.
Yeah.
And they'll also offer a variety of courses for consumers, all skill levels.
So it's a brand initiative. Exactly. A significant one, aiming to enhance the brand, promote responsible firearms ownership, and, showcase their products in a world-class setting. They called it a brand flywheel.
A brand flywheel. I like that. Okay, so what does this all mean for the company's outlook? What are they guiding for?
Right, the outlook. For Q2 FY26, they anticipate a normal seasonal environment. Sales are expected to grow significantly sequentially from Q1, which is typical heading towards the holidays.
But still down year over year.
Yeah, still expected to be approximately 3-5% below Q2 of fiscal 25 levels.
Okay, and margins.
Gross margin is projected to stay roughly in line with Q1, so around that 25.9% mark. This is partly due to that August factory shutdown they mentioned and those ongoing steel tariffs.
Ah, yes, the tariffs. Did they quantify the impact?
They did. The CFO flagged them as about 120 basis point drag. That's 1.2 percentage points on the Q1 margin. And that headwind has continued.
Got it. What about operating expenses?
OPEX is expected to increase by about 20% over Q1.
20%. That's quite a jump. It is. Apparently, half of that increase is driven by profit sharing, which I guess is a good problem to have.
Yeah.
The other half comes from costs tied to the Academy grand opening, promotions, sales activity, and just increased volume distribution costs.
Makes sense. And taxes.
The effective tax rate is anticipated to be around 33%.
So overall, they sound cautiously optimistic about maintaining or maybe even expanding market share for the full fiscal year, despite, all the macroeconomic uncertainties.
Right. And there's that interesting long-term play too, right? You mentioned it earlier.
The suppressors.
Exactly. They're anticipating a healthy market for suppressors for their GEE brand starting in January 2026, driven by new tax law changes, NFA-related stuff, and what they believe is significant pent-up demand. So exploring new growth avenues there.
Interesting. How does management view the broader firearms market conditions right now? Are things stabilizing?
They describe the market as normal, cyclical, and reflecting traditional seasonality. They acknowledge it's challenging, but said underlying consumer demand remains above those pre-surge levels we saw a few years back.
Okay, and NICS checks?
NSSF-adjusted NICS checks were down 8.1% year over year in July and 9.9% in August. But crucially, they're still maintaining a pace of over 1 million per month. That suggests, a normalized post-surge environment, not a collapse.
Right. So for you, the listener, the investor, what does all this signal, especially given that kind of lukewarm market reaction we mentioned earlier?
Yeah, that reaction is telling. The fact that the stock's after-hours move, that plus 0.5%, was so much less than the options market's implied 9.3% move. It really suggests that while the company beat these lowered expectations, investors likely had these modest improvements sort of priced in already.
Yeah, makes sense.
So the focus now really shifts to those lingering headwinds, the tariff pressure on margins, those sequential ASP declines, and importantly, the need for stabilization in that long gun segment.
And it's worth remembering, SWBI stock has really lagged the major benchmarks. Over the past year, the stock was down over 42%. Meanwhile, the S&P 500 was up over 16%, and the consumer discretionary sector, XLY, was up over 26%.
Yeah, that's a significant performance gap. It shows there's still a lot of investor skepticism.
Yeah.
And this leads to the important questions analysts were asking on the call about ASP trends, about real expansion opportunities in long guns, like lever actions, or those NFA items like suppressors.
And about strategies for older products, future promotions, things like that.
Exactly. They want to see a clear, sustainable path forward.
So looking ahead, what are the potential catalysts? What could actually move the needle for Smith & Wesson in the near term?
Well, the next big test is the Q2 earnings print and how they perform during the crucial holiday season buildup. The success of upcoming new product launches and marketing campaigns will be really key.
And maybe some macro help.
Could be. Any potential relief from those tariff pressures or maybe favorable product mix shifts boosting margins, that would help. An uptick in NICS checks, perhaps influenced by macro events or even, electoral headlines, could also stimulate demand. But ultimately, investors are looking for tangible proof that this innovation strategy can sustainably drive margins and that long gun sales can finally find a floor and maybe even grow.
All right, it's time for our This Is Not Financial Advice segment. We put on our imaginary hedge fund analyst hats and pitch an outrageous but plausible trade idea for Smith & Wesson.
And remember, folks, this is purely for entertainment and thought-provoking discussion. We are absolutely not recommending any trades. Please do your own research.
Okay, so given the market's kind of conservative reaction to the Q1 beat, despite the strong new product contribution, that impressive handgun performance, and this big strategic investment in the Academy, it feels like the market might be underestimating Smith & Wesson's long-term brand-building power and its potential to keep taking share.
Yeah, I can see that argument. So my outrageous but plausible idea, playing off that, might be to initiate a long position, maybe through something like a bull call spread.
Okay, define the time frame.
Let's say expiring, maybe out in March 2026. Give it some time to play out. The idea is to capitalize on a potential re-rating as the market, hopefully, starts to recognize the full impact of that Academy brand flywheel.
The continued success of their product innovation.
And especially that anticipated healthy market for NFA items like suppressors starting in January 2026 because of those tax law changes. The thinking is the market has priced in the current headwinds, but it might be too dismissive of these future catalysts that could really shift the narrative from margin pressure back to growth.
Interesting. A bet on the strategic initiatives paying off and the suppressor market opening up. Plausible, certainly outrageous. All right, that wraps up our deep dive into Smith & Wesson's Q1 FY26 earnings. We've seen a company navigating a pretty tough promotional market using strategic innovation, relying on strong handgun performance, making significant brand investments like the Academy.
All while battling those persistent tariff headwinds and trying to stabilize the long gun side of the business.
The market seems to remain cautiously constructive, really looking for sustained margin performance and that stabilization in key segments as we move forward.
Yeah, the big question for investors is whether these strategic moves, especially the Academy and the focus on innovation, will actually translate into a meaningful re-rating for the stock.
We hope this summary has equipped you with some valuable insights. And remember, the information shared here is for educational purposes only. It is definitely not financial advice.
Absolutely. We always encourage you to continue your own research and explore the implications of these developments for your own investment decisions.
Thank you for joining us on Talk Tickers. We look forward to our next earnings deep dive with you.